If we look at the past 6 months of FOMC meeting minutes, or essentially where the Fed governors came together and decided what the economic policy was going to be as far as increasing rates or lowering rates, the optimism as far as lowering the interest rates has been pretty much under 10%, meaning that there were expectation that the Feds were going to lower rates was just non-existent. Now, fast forward to current day. Now, when I did this search, what I ended up doing is I went to tools and I did within the past week. And within the past week, the complete sentiment has changed significantly. Why? Well, at the end of the day, we need to lower the interest rates when unemployment starts to creep up. And the Iran conflict is not helping us either. Essentially, with Iran and the oil issues that are happening right now, it's causing those costs to go up. And so a way to go ahead and combat inflation and or high prices is to stimulate the economy, thus lowering the Fed funds rate. But that said, quite frankly, I don't like to look at the actual news. I like to look at what the financial chart says. And so here's what the financial chart is telling me from a data perspective. To illustrate this point really simply, I want to go ahead and show you what 100 years of history looks like on the Dow Industrial Average. So here's the main point. I want you to follow essentially where I'm marking. You see when it crosses on the upside here? Every time that it crosses on the upside, what happens? Well, when it crossed here, price got worse. And when it crossed here, price got worse. Well, the same thing also happens when it crosses on the underside. When it crosses on the bottom, sure enough, price got better. And when it crossed down here, price got better. So now if we go into current time frame, but now we're just going to go in and look at the actual interest rates. So if we look at what's happening, okay, well, it crossed here. What happened? Pricing tried to get better with interest rates. And now if we zoom in, it's trying to go ahead and cross again and go to the upside. Now, what we're looking at is what's called the MACD and or the divergence and convergence. A simple way to put it, this is the momentum of what's happening with interest rates and or this particular asset class. We combine that with looking at the price action and looking at the other indicators such as the RSI, which is at the top right here. RSI is relative strength index. Long story short, this is going to basically communicate overbought or oversold. The reality is that on these indicators, it's trying to cross to go to the upside and it's trying to cross to go to the upside. And pricing has been in this battle. Now, here's the most important part. You're going to see a big triangle here on the screen. Outside of all the lines, the one that is going to be probably really easy to see is going to be this triangle. What we're likely going to see over the next couple of days is it's going to go ahead and fight this little battle, and then it's going to get back in, and then it's going to break to the upside. If we look at the Fed funds and look at their money policy, your tax return and my tax return, they both end on 12/31. However, for the federal government and or the Federal Reserve, that is actually September 30th. And so that's essentially when all the fiscal money policy typically gets reset. And on top of that, we just appointed a new chair position to the Federal Reserve. The current administration, not getting political, but if the current administration prefers to have lower interest rates, well, chances are they're going to appoint someone that is going to give them lower interest rates. And thus the new appointee is going to go ahead and be in line with policy administration ideals, or more so what their goals are. So we just got a new chair position appointed, which can only happen every 12 years. And that new person is going to be taking over, or more so over the control and being the chair of the Board of Governors for the Fed Reserve. And that happens in September. So here's what all this sums up to be. At the end of the day, you go back the past 6 months, the optimism for rates to come down or getting lower was not there. Now it is, abundantly. And while I can't definitively tell you 100% what the future is going to be, I can tell you with a very high odds probability that the rates will likely come down. I'm not saying they're going to go to 3%. I'm not saying they're going to go to 2%. But to get into the fours naturally on its own instead of paying points to go ahead and buy down the rate, it's a very high likelihood of probability.